If you're an incorporated business owner in Canada, chances are you've built up some retained earnings in your corporation. Maybe you've even started investing some of that cash, holding GICs, dividend stocks, or even a conservative corporate portfolio. Sounds responsible, right? But here's what most business owners don't know. The more successful your corporate investments are, the more they can quietly erode one of the biggest tax advantages that you have. I'm talking about the small business deduction, the lower corporate tax rate on your first $500,000 of active annual business income. Once your corporation earns more than $50,000 per annum in passive investment income, the CRA begins to claw that deduction back. And at $150,000 per year in passive income, it's totally gone. That means instead of paying 11 to 13%, you could be paying 27 to 30% tax, even on income from your core business. And the worst part, most business owners only find out after the fact that the clawback has cost them thousands. Hey there, I'm David Drummond, founding partner at DLD Financial and CFP. We help incorporated professionals and business owners across Canada protect their corporate wealth, reduce tax, and build long-term strategies that actually work. And one of the most misunderstood tax traps out there, especially if you've built up $250,000 or more in retained earnings, is the passive income grind. In this video, I'm going to walk you through what the small business deduction is, how the clawback works, why even conservative investing can trigger it, and how to restructure your portfolio to avoid it without sacrificing growth. Because this isn't just about tax, it's about keeping more of your hard-earned business income and making sure your investments support your plan and not work against it. So let's dive in. Part 1. What is the small business deduction and why it matters? Let's start with the basics. In Canada, the small business deduction, or SPD, is what allows active Canadian-controlled private corporations, or CCPCs, to pay a much lower corporate tax rate on their first $500,000 of active business income. That lower tax rate, it's between 11 to 13% depending on your province. Now, compare that to the general corporate rate, which can jump from 27 to 30%, and the savings become clear. The small business deduction is one of the biggest tax advantages for incorporated professionals and business owners in the country. It's what allows you to keep more profit inside the corporation, invest from a larger after-tax base, and build up retained earnings over time for retirement, real estate, or long-term planning. But here's where it gets tricky. The deduction only applies to active business income you earn from operating your business. If your corporation starts earning too much passive income, such as interest from GICs, dividends from non-affiliated companies, taxable capital gains, or rental income from real estate, you could quietly lose access to that preferred rate. And that's where the passive income grind comes in. In the next section, I'll explain how that grind works, what the CRA looks at, and how even safe investments inside your corporation could be costing you thousands in unavoidable tax. So part 2, the passive income grind, how you lose the small business rate without knowing it. Most incorporated professionals know they pay a lower tax rate on the first $500,000 of active business income. But what many don't realize is that this benefit can quietly be clawed back by the CRA, not because your business is struggling, but because your investments are doing too well. Let me explain how this works. The passive income grind in simple terms. If your corporation earns more than $50,000 per annum in passive investment income, you start losing access to the small business deduction, dollar for dollar. Here's the formula. For every $1 over $50,000 in passive investment income, you lose $5 of your small business deduction limit. Once your corporation hits $150,000 or more in passive income in a year, you lose the deduction entirely. Instead of paying 11 to 13% tax on your active business income, you now pay the full general corporate rate, often 27 to 30%, depending on your province. That could mean tens of thousands in additional tax on your business earnings, just because of the way your corporate investments are structured. So what counts as passive investment income? This includes income from interest on GICs or high interest savings, dividends from non-connected corporations or US equities, taxable capital gains from corporate investments, rental income unless it's considered an active real estate business. So even Even something as conservative as $1 million in GICs earning 6% could earn $60,000 in interest, enough to trigger the clawback. Why most business owners miss this? This tax doesn't show up as a line item on your notice of assessment. It's baked into your corporate tax return. And if you're not looking closely, you might not even know it's happening. Many business owners only find out when their accountant tells them after the fact that their tax bill jumped and they don't understand why. That's why it's so important to get ahead of it. So part 3, how to avoid the clawback while still growing your corporate investments. Losing the small business deduction doesn't mean you made a mistake running your company. It often just means your investments weren't structured with tax efficiency in mind. The good news, you don't need to stop investing. You just need to be smarter about where and how those investments are held. Let me walk you through a few of the most effective ways to protect your deduction while still growing your wealth inside your corporation. Number 1, choose more tax-efficient investments. Not all investment income is treated the same. Some income, like interest and fully taxable dividends, are counted towards the passive income grind. But income like deferred capital gains, return of capital, growth from corporate class investment funds or segregated funds, these are often excluded or deferred, meaning it doesn't immediately count towards the $50,000 passive income threshold. By shifting your corporate portfolio to these types of investments, you can still grow your wealth while keeping your passive income grind exposure low. Number 2, you can use permanent life insurance as a corporate asset. A lesser known but powerful strategy. Corporately owned whole life insurance, when set up properly, the cash values grow tax sheltered, there's no passive income reported each year, and the death benefit can flow through the capital dividend account, or CDA, to your estate tax-free. This allows your corporation to accumulate significant value without triggering the passive income rules. For many clients with large retained earnings, it becomes a cornerstone of long-term tax planning and legacy protection. Number 3, coordinate with personal withdrawals and TFSA RRSP strategies. Sometimes the best move isn't to hold the investment corporately at all. If you're near retirement or in a lower personal income year, it may make sense to withdraw some retained earnings, pay the personal tax, and reinvest the proceeds inside your TFSA, RSP, or spousal RSP. This can pull taxable growth out of the corporation and into a more tax-efficient personal plan. It's all about timing and coordination with your broader retirement income strategy. Number 4, be cautious with HoldCos and corporate group structures. Some advisors recommend using a holding company to separate business income from investment income. This can work, but only if the companies are not associated under the Income Tax Act. If they are associated, the CRA will combine passive income across all entities for the purpose of applying the grind. A holding company only solves the problem if it's structured independently, and that's something that needs to be reviewed on a case-by-case scenario. So the bottom line, you don't have to stop investing through your corporation. You just need to optimize your mix so your growth strategy doesn't quietly erode your tax advantage. In the final section, I'll walk you through what we do for clients to monitor and fix this, and how to take the first step if you're unsure where you stand. Part 4, final thoughts. Well, let's bring this all together. If you're an incorporated professional or business owner in Canada, you've already taken the smart step of building inside a corporate structure. You've put in the work, you've built something real, and your retained earnings are growing. But here's the problem most people miss. As your corporation becomes more successful and starts accumulating more investment income, it can quietly work against you from a tax perspective. That $50,000 passive income threshold isn't indexed. It hasn't changed since 2019, but your portfolio probably has. And once you cross that line, you're no longer just paying tax on investment income, you're paying higher tax on your active business income as well. That means the business you worked so hard to build is now funding tax on both sides. This isn't just about investments, it's about coordination. If your accountant is focused only on the corporate return and your advisor is only focused on portfolio returns, you'll be missing the bigger picture. Smart planning means looking at where your income is coming from, how it's being taxed, and what you can do to protect your advantages while still growing your net worth. And that's what we help our clients do every single day. What we do for our clients. When we work with incorporated clients, we don't just look at their portfolio in isolation. We look at their current and projected passive income, their eligibility for the small business deduction, how to coordinate investment returns across their corporate, personal, and registered accounts, and whether strategies like permanent life insurance, capital gains deferral, or income smoothing can help protect their after-tax wealth. We build a plan that works, not just for today, but for the long term, because this isn't just about squeezing out the last bit of return. It's about keeping more of what you already earn. What you can do next. If you've built $250,000, $500,000, or even $1 million or more inside your corporation and you're not 100% sure how your investment income is being treated by CRA, now is the time to get proactive. You can book a free retirement and tax strategy call with our team, and we'll walk you through how much passive income your corporation is generating, whether you're approaching the clawback threshold, and what steps you can take right now to reduce risk and improve efficiency. Whether it's adjusting your investment mix, exploring insurance-based solutions, or coordinating with your TFSA and RRSP/spousal RRSP strategies, we'll give you the clarity you need to protect what you've built and keep more of it working for you. If this video helped you understand the small business deduction clawback and how to avoid it, please don't forget to like, comment, and subscribe. It'll really help a lot more Canadian business owners find clarity that they would need to make smart, tax-efficient decisions. Thanks very much for watching, and I'll see you in the next one.